What's up, YouTube? We are going to go over Disney in this video. Now, Disney was requested by someone who posted in the comments on another video. He also requested four other stocks to have valued, which we'll do this week as well for him. If you are interested in wanting to have a company you're interested in looking at, having it valued, drop that down below in the comments. And as they come in order, I'll do them. And also, while you're down there, if you would like and subscribe, that'd be great. All right, so let's get into it. So, Disney, ticker symbol DIS, over the course of 1 year, down 25.6% year to date, down 5%. So, Disney, we're going to hop over to their earnings report real quick. So, with Disney here, they have their revenue comes in over the course of the last quarter, $22 billion. Um, Really, the only major increase of cost of expenses here was their products, and I'm assuming it had a lot to do with inflation and probably freight and shit, all that stuff. So I'm assuming that's probably temporary and that'll come back down. Otherwise, in terms of, increases and stuff like that, it really wasn't too many big jumps anywhere. Nothing that really was like, oh wow, that's a lot. So really only up $600 million. They're up, $700 million, $800 million in revenues year over year. So their total gross profit is only 12% currently. They had this big restructuring and impairment charge of $2.6 billion. And let's hop over to that real quick to see what that was all about. So in this note here, they posted what the restructuring and impairment charges were, and basically what they did was they terminated certain third-party licenses for the right to use content primarily on their direct-to-consumer platforms, and of which 2 billion was related to write-offs of produced content, and zero point 0.4 billion was related to termination of the license agreements. And then, so it seems like that was like, they're trying to clean up the company. It's, they're trying to make it more efficient, make more money, get rid of all the garbage and make it more profitable. All right, so back at the top here, net income. Because of this impairment charge, this restructuring, they lost $153 million last quarter. Last year they made 1.5 billion. So if you strip this out and add back in $2.65 billion, basically you're looking at possibly being 2.5 $2.4 billion of net income. So they would have been positive last quarter had they not had to spend a bunch of money making, to clean things up that the seems like the prior CEO kind of messed up. Because speaking of which, Bob Eager, I believe is how you pronounce his last name, he ran Disney from 2005 to 2020 and then retired, and then like I believe in November of 22 they asked him to come back and he did. And so ever since then he's been trying to clean up the business and make it better. Which he did make a note saying that he has made it a lot better. Which we'll get to in a moment too. So currently on the balance sheet they have $11.4 billion of cash. They've got $22 billion of short-term debt and a total of $88 billion of short-term and long-term debt combined. Free cash flow here. So they, over 9 months here, so basically, I don't know why they didn't just do a year, but they did $1.5 billion of free cash flow in the last 9 months. So basically that's $2 billion of free cash flow annually. So free cash flow, they're doing okay. Last year, they did negative free cash flow. So they're down in the last 9 months anyway. They were down, what's that, 300-ish million there. So in terms of free cash flow, now they're starting to head in the right direction. So that's good to see. So down here in the media business, the media business only makes them 8% profit margin. And then on the parks and products, they make 29%. If they can get their subscriber count from where it is now, which is 146.7 million subscribers, and if they can get it somewhere close to Netflix of 239 million subscribers, so basically double their subscriber count almost, like, you know, their profit margin should increase quite a bit if they can get that to turn around. Big, but there is this statement from their 8K that their CEO put out and saying Disney to restructure the company, improve efficiencies, and restore creativity to the center of the business. So that's what they're trying to do. They're trying to clean it up, improve efficiencies. They got rid of some people, terminated some people. They got rid of, I think they got out of their business in Russia. Um, so they're trying to create a more cost-effective, coordinated, streamlined approach to operations that has put us on track to exceed our initial goal of 5.5 billion in savings. So that's huge, as well as improve their direct-to-consumer operating income by roughly $1 billion. So that direct-to-consumer income is their media. Uh, so to see that they're working on growing and getting more revenue out of that media business, I think is going to help this company, grow quite a bit. The other thing that's not helping Disney right now, especially the Disney parks and stuff like that, in terms of growth, is, you know, all these interest rates, and people are kind of still have some fear of recessions, and they also have less money these days because of all the interest rates and cost of goods and all that stuff. So there's probably less people going to Disney because Disney is expensive. I don't know how many of you guys go to Disney, but Disney's not a cheap place to go to for sure. So, that's a quick summary of what I found on the 8K and the 10Q here. So, hop over to the valuations. So, Disney, ticker symbol DIS, return on invested capital only 3.3%. That's terrible. You really want to see 15% or more on that. Down here, analysts expect this company to start picking up next year. In terms of EPS, in terms of over revenue growth, they're not seeing much growth at all. So our EPS growth, 18.7%, which makes sense because they're trying to clean up the company. They're not, right now, it doesn't seem like they're growing much, but they're trying to clean it up. So if they're cleaning up the company, your earnings per share is going to get better. However, the revenues aren't going to grow a whole heck of a lot. But 6% revenue growth, though it comes up to here, it gives us a Peter Lynch fair value of 0.27, only a Peter Lynch fair value price of $22.97. Comparisons for multiples here gives us $70.40. Our manual PE, this company will take with cash from operations and everything else they got going on here, their market to equal their market cap, it'll take 31 years. Pretty rich. Price to book. Total assets, $203 billion. Total liabilities, $92 billion. Shares outstanding, 1.8. Gives us a price to book of 1.3. Previous 5 years is sitting around 3. PEG ratio, really bad, 11. Forward-looking PEG, though, cleans up a little bit better to 2.76. Graham's valuation here, current AAA corporate bonds, 4.93. I changed this to 2 because this is a more stable company, and that actually helped the intrinsic value quite a bit. But gives us intrinsic value $50.34. DCF. Typed in all their numbers here for the interest expense, income tax, pre-tax income, market cap. Gives us a weighted cost of capital of 7.22. So 7.22 populace, 7 over here. And perpetual growth rate of 2.5%. Cash from operations, you can see over the course of time, was doing great. And I believe this is right around when Disney Plus launched. And that's when it just crushed this company in terms of, bringing cash down like that. So since then, it's just been stagnant. It hasn't grown or shrunken much. It's actually just right around $6 billion. Then their capital expenditures here went from 3.6 up to 4.9. So CapEx has gone up $1.3 billion in the course of the last 6 years, and their cash from operations has gone down and cut in half. So free cash flow, as you can imagine, is going downhill quickly, down to $1 billion of free cash flow. Used to be $8.7 billion. Cash and marketable securities, $11 billion on balance sheet, gives us a discounted cash flow price per share of $57.29. Over here, Rule 72, current EPS, $1.23. The highest or the lowest growth rate, EPS growth rate, 18.68. 18.68 goes into 72, 3.85 times. 3.85 times goes into 10 years, 2.59 times. So 2. So it's right in between 2 and 3 here. I chose 7.5. 7.5 over here gives us a fair value of $70 a share. Purchase price with 30% margin of safety of $49.03. Down here is our summary of all our values. It gives us an average price of $54.21. Purchase price $37.95. Now, some of the key takeaways of the balance sheet, the 8K, and this valuation spreadsheet here is that, you know, they're cleaning up the business. They're trying to make it efficient and profitable, more profitable. Bob Eager's back in charge. He was, like I said, he was in charge from 2005 to 2020. Um, and they asked him to come back. So, and he accepted, and he's helping take care of that and making it better again. So they do have a cruise ship launch, but it's not going to be until I believe I read 2025, 2026 timeframe. Now I believe that, in my opinion, will be. I can imagine that'd be super profitable for them because if they can charge as much as they do for for the parks and staying in their hotels on the resort, I can only imagine what their profit margins will be on these cruise ships because it's kind of like the park is like a cruise ship in a sense, but now it's actually going to be on the ocean. It's going to be a whole different experience for a lot of people. I think initially for the first couple years is going to be quite a big hit. Um, so I'm interested in seeing where that goes. I think that could be a good thing for the company. The only downside is there's only two cruise ships. I don't know if they're just doing two just to wait and see how it launches, or if that's all they want to invest into that initially. Maybe they'll build another two or another eight. Who knows? Um, Also, Disney Plus has the potential to double its subscriber count, which would be pretty big deal for that side of the business as well. All the bad just comes with all the financials. It just the financial side of things does not look good for this company currently. Based on history to today, everything is gone the wrong direction except for revenues. Revenues is the only thing that's grown, but everything else has gone the other way. So let's hop over to the stock chart. So I'm on a monthly chart here, and even if we hop over to the weekly real quick, we can see we are just in a very steep downtrend here on Disney, and it is holding this downtrend still, even at these levels. And it is looking like it maybe wants to break below this, what appears to be a pretty solid support range of $80 to $85. However, if we do break below, I would say $80 here, I think your next stop is going to be roughly 45-ish dollars, honestly, because there's nothing holding this stock up if it breaks below 80 bucks. 80 down to $43 is probably, and based on our valuations here, that is, the range of fair value today based on these numbers. So that's what I see on Disney. I don't see a real quick bounce unless they start turning their revenues around, unless the media business starts going higher. I think Disney has, you know, look at the markets too. Look at the Qs and the SPY. They're up here, right? Disney is down here. It's at its lows. Like nobody's interested because look at the fundamentals of the company. It's not good. So I personally, if you wanted to trade this, if you wanted to buy this here, I would put a stop loss at 80 bucks. And honestly, I would expect this company to break below 80 bucks and come into this range. Now, in this range, it's a little more attractive because of some of the future outlook of the company, but that comes with risk too. So, personally, if it was me wanting, I'd be waiting till if it got down to like 45, 50 bucks, then I'd be like, okay, I'm gonna buy some Disney stock. So, real quick though, let's also look at the numbers on Disney. So in 2014, they made $48.8 billion. In the last trailing 12 months, we'll go with these numbers since these are the most recent numbers. They're up almost $40 billion in 8 years. So that's pretty good. That's pretty good. Operating income, 11.5 billion, only 7.7 billion. So down $4 billion in operating income, even though they've made an additional $40 billion, they've lost money in operating income. So not something you want to see there. Cash flows. It's coming out of cash flows. 2014. Cash from operations. $9.8 billion. Today, $7.5 billion. And again, they're on their top line, they've added $40 billion. And their cash flows, cash from operations is down $2.2 billion in 8 years' time like that. Balance sheet. 2014, they had $3.4 billion of cash. They currently have 11.4. Okay, good. Cash has grown. Current assets, where are their assets at? Total assets. They were at 84. They're up to 200. Call it 204 billion in assets. So the assets have grown quite a bit. That's good. Total liabilities. Let's see here. Total liabilities 35, 36, up to 30, or only up to 95. So pretty good. They grew this by 60. They grew their total assets by 120 basically. So they've doubled their asset count versus their debt count. So that's good. Now, if you were an investor in 2014, you would have made $0 on Disney in the last 10 years. So 10 years ago, Disney was trading at $86 a share, and your financials looked better than they do today. So I don't see a reason why 10 years ago, why today is a better buy than 10 years ago, based on the fundamentals of the company. They've got more going on, but they're making less money. So that's my take on Disney. Let me know down below what you guys think of Disney. Let me know what you guys think of this sort of valuation system going on here. Also, again, if you want any companies that you're interested in buying valued, drop them down below. And if you found value in this video, like, subscribe, and we will be back tomorrow with another stock valuation.